All right, Candle Range Theory Trader, back with you with a deep study on Candle 2. All right, so let's not waste time and get right into it. Now, obviously, the warning or disclaimer, this can be a high-risk strategy. Trading Candle 3 is the lower risk option out of the Candle Range Theory. So, but before this deep study, our focus is going to be this middle candle right here, the elusive Candle 2. So, how do we put the odds in our favor if we want to choose to trade Candle 2, right? On the 4-hour chart. Okay, if you're wanting to trade candle 2, look for candle 2 to form for the 5 a.m. 4-hour candle or the 9 a.m. 4-hour candle. Can it form on the others? Yes, it can. It's just these are during London and New York sessions. That's why I say that. If you trade the 8-hour chart like I do, look for candle 2 to appear during the 1 a.m. or 9 a.m. hour. It's not that 1700 won't offer it. It's just that I'm not interested in that. All right, so the number one tip that I can give you is this. If you don't get anything else from trying to trade candle 2, get this. Only trade off of what you believe to be the high or the low of the day. I'm going to say this now. You're going to get this wrong, and you're going to get it wrong a lot. What I mean is you're going to see a formation. You're going to think it's the high of the day. You're going to get a red fair value gap, and then price will keep right on going up and stop you out. That's going to happen. Okay, so you need to just be prepared for that. That's why I say candle 2 can be high risk. So the benefit, though, obviously with every minus, there's a plus and vice versa. Candle 2 can offer smaller stop losses when you get it right versus candle 3. Because when you do nail the high of the day, you have to remember that high of the day is the strongest resistance there is, the low of the day is the strongest support there is. That's the market saying that this is the lowest I'm going to go for the next 24 hours, period, or 8 hours or 16 hours, however much, okay? It's just the low of the day. It's just the high of the day. They're saying, okay, this is it. This is the end. So now I'm reversing. So just putting your stop loss below the low or above the high. I mean, when you're right, you're gonna get paid. So what are our entry signals though for this system? It's going to be a change in the state of delivery, which I will go over. The first fair value gap that forms off the high or lower of the day. It can also be railroad tracks or morning or evening star, which is a little less common, but we'll get into that. Now, final reminders as well. Do not expect big moves in candle 2. Because remember, candle 2 is a consolidation candle for the most part. Now, sometimes you'll see candle 2 sweep the high of the range, and it'll go all the way down and close out the range too. But that's a little more rare, okay? But don't expect to take candle 2, and then if you trade like a 4-hour chart and you take an entry on candle 2, by default, if you're trading the 3 candle range theory, your payout doesn't come until the next candle. So you're talking about 8 hours, okay? If you're trading the 8-hour chart like I do, if you take a candle 2 setup on the 8-hour chart, you're talking about a 16-hour trade, 8 plus 8, 16, okay? Now, you can also feel free to scale in when candle 3 comes for a bigger gain, or just let the first position on candle 2 ride. That's probably the safer option to avoid, blowing the account if you risk too much. One trade a week, if you find a good candle 2, can pay a lot as long as you scale in as well. Keep that in mind. And if you trade the 9 a.m. candle 2 on the 8-hour chart, be prepared to hold the trade overnight. So let's look at some real charts here. So this is a 9 a.m. chart. We have candle 1, candle 2, which does sweep both sides. This isn't the best candle 2, but this is just one of the first ones that I came across. So obviously we're looking to trade off of this high of the day. Okay, so let's go down to the next one. And so this is the 5-minute chart. And you have a couple options here. So first off, let's talk about changing the state of delivery. And there's other videos on YouTube about that. Different people, they trade it different ways or describe it different ways. This is how I describe the change in state of delivery. I like to see whatever candle makes the high of the day. Once price closes below it, that's my change in state of delivery. So I put a line right at the candle that makes whatever the high of the day is, which was this one green candle right here. Now, if it's a series of green candles, you can either do the last green candle to appear, or you can do the top one. I'll show you that though, just to explain it to you. But this is always the best option. If you see one candle make the high, one green candle, that's your best case scenario. So when price closes below this green candle, you can consider that reversal. That doesn't mean it can't retrace back into it, but remember your stop loss goes above this high. So this setup gave entry. You could have got anywhere from 10:15 a.m. to 11:45 a.m. Eastern Standard Time. And you also had another example with a fair value gap forming right there, which gave another chance to get in. So there you go. And then obviously price, that was the result. If you would have caught this high up here for the next 4 hours, it just went right back to where it was because it already did spike the low and then it just came back. So that was that. Okay, so that was this right here. This 5-minute chart is this candle right here, this middle candle. All right, it just spiked in both directions and closed right there and then tanked. So you see here, it opened, spiked in both directions, and then closed right here. So that's it. So it's like a 50-50 proposition. Some people went long, some people went short. In this case, the shorts won. Let's take a look at the next example. This is a long example. This one's a little cleaner because it didn't sweep both sides of the range. So we have candle 1 and candle 2. So we're looking to trade the low of this candle right here. And we want to get all this upside. So let's go down to the 5-minute chart. This one right here would have been the best entry, would have been a fair value gap entry. Now, when I say change in state of delivery, though, I noted here that there were too many red candles for a change in state of delivery because the thing is this. This how some people teach is that if you see a series of red candles, 1, 2, 3, 4, 5, 6, 7, price needs to close above this red candle right here in order for the reversal to be valid. When it's this long, that's not my preference. So like I said, you can either put your change in state of delivery on the last red candle before the low forms, or you can just disregard it altogether and just say, hey, look, I want to look for a fair value gap. And your stop loss can either go below this fair value gap or below the low of the day, either one. Okay, the safest option was always going to be the low of the day because you believe that price will not go back to this level. Fair value gaps can get taken out, but if you get candle 2 right, this low should hold. Okay, so let's keep going. And then obviously, I'm sorry, the result. So, you would have been in it down here. And then this is another 8 hours and then 16 hours. So, just a straight rise. You could have been out on this candle here because this one actually spiked higher than this one did. So the next candle, though, just candle 1, candle 2, you look to take your exit on candle 3 when it spikes up to the upside. Okay, so that's that. All right, so that's that one. And then let's take a look at this 1 a.m. long example. So you have candle 1 and candle 2. So we're looking for the low of the day on this candle before 3 pops up. So let's see, the low is right here. So you have this one would have been ideal for a first fair value gap entry. And again, you talk about for a change in state of delivery, you got all these red candles, 1, you got 2, 3, 4, all this long red here. Some people teach that, again, you have to have price close above this first red candle in the series of reds before the reversal is valid. I don't like that because this is too much price action for me. I like to see, I would just say a fair value gap is just your best option. So, price retraced into it right here. So you could have got in from 4:15 a.m. to 4:45 a.m. Because typically, even though the candle opens, this black line is the open price of the 1 a.m. candle. You want to be in below the open price of the 1 a.m. candle. You expect for price to just manipulate and then close somewhere around the open price. Like I said, it's supposed to be a doji. That's really ideal. So this is not where your big move comes. Your big move comes on the next candle, which is this one. All right. So that was that setup there. And of course, that was a good payout. But you're trading outside of the range. Okay. So there you go. Now let's look at the profit potential between candles 2 and 3. So I have here a 3 candlestick pattern. Candle 1, which is the range. Candle 2. Then candle 3 on a New Zealand yen. So let's take a look at candle 2. This price action here on the 5-minute is this green candle right here. So obviously we're trading off the low. So your entry could have been on these railroad tracks here. You got 1 candle down and then 1 candle up. So entry could have been right there. And then you just ride it on up. It was pretty much a straight rise. Very little, if any, drawdown on that. Okay. So that's one option off, again, the low of the day. Or if you just wanted to trade candle 3, which is what I teach more often, you had a series of fair value gaps here. I'm pretty sure this was probably news related where these big spikes came in. But, you could have just used the fair value gap as your possible entry, expecting price to break out of the range, which it did do. And then while it did continue up, this price action is kind of, slow. So, I would have been comfortable with an exit at this big spike up here. That would have been fine. But let's take a look at the profit. So compare candles 2 and 3. So let's say you're a candle 2 trader. You say, you know what, CRTT, I want to just trade candle 2 and try to find those entries and just let it ride. That's fine. You would have got about 130 pips off of that 9:55 a.m. entry that I showed. This candle right here. This was at 9:55 a.m. So then you just hold it overnight and that would have been it. Okay. 130 pips in your pocket. Done. If you just trade candle 3, which was this one right here, okay, that one would have been at 7 p.m. All right. And you would have got 100 pips. That's fine. Now, if you want to be an overachiever, let's say you want to take candle 2 and candle 3. All right. So candle 2, your first entry would have been good for 130 pips. You let that rock. And then you take another entry on candle 3. Okay. So entry number 2, that should have been candle number 3, but that's a typo. So that would have been good for 230 pips. Okay. Across the two positions. So you tell me which one fits you. You don't have to scale into candle 3 if you don't, because the thing is, you may think you have a candle 2 and it doesn't work out. It is what it is. Or you could just, if you're content with 130 pips, that's a great payday. If you're content with just candle 300 pips, that's a great payday as well. If you want to do this right here, if you want to do this, only one of these a week and you're good. Between 100 and 200 pips a week, to me, is more than fine. Okay. So let's do a quick live example before we wrap this up. So I'm going to go to $CAD right now. I'm on the 8-hour chart. And we'll find, just so you can backtest this for yourself, because I'm big on people backtesting and doing the work themselves. So I'm looking for a candle 2 on the 8-hour chart that shows between candles, or shows between 1 a.m. and 9 a.m. So I think I have one right here. And hopefully it wasn't in the, it shouldn't be in the presentation. I don't think it is. That swept both. I was going to do this one for a candle too, but it swept both sides. I really don't care for that. I like for them to just sweep one side. That's the best type of candle too you're going to see. So let's see. Looking. Let's try another pair. Let's try dollar Swiss. Okay, there we go. One just popped up. Awesome. So I'm going to do this candle 2 right here. This is going to be this red candle. So let me isolate the range. And what you're going to do is just study. If you want to try to trade candle 2s, again, it's high risk, but if you think you can, practice good risk management, it could be worth it to you. So this is the high. This is the low of candle 2. This is at 1 a.m. All right. I'm going to do my replay option here. Okay, so these are the 3 candles. Now what I'm doing though is I'm looking at this high of day level. This high of day, of course, I use the mark levels indicator to just, you can eyeball it as well, but it just shows it high of day and that's it. So let's take a look and see what our best entry would have been. Again, this is at 1 a.m. So I'm going to drop down to the 5-minute chart. Throw my 1 a.m. template up here. Reset the chart. Okay, and here we go. Well, I don't have my market levels indicator up here, but the high of the day was this candle right here. The high of the day was formed at 340. Okay, so let me see if there's any fair value gaps. I don't think there are that held until like later on. No, okay, there was one. All right, off the high. Okay, so remember this right here is the high of the day. I'm just going to put an arrow on it so you don't lose track of it. This is the high of the day. If you wanted to do a change in state of delivery on the last green candle, you could have did it like for right here. Okay, because this was the candle that made the high. Price didn't close beneath it until, because the high of the day was made at 340. Price didn't close beneath it until 4:50 a.m. Okay, so that was a little bit of waiting. You would have had to just sit through all this consolidation. It eventually did play out, but you would have to wait on that. So you had a few options. You could have entered right here when it closed. Let me make this bigger. Your entry could have been right here when it closed beneath the candle that made the high of the day, the open price of it. Okay, right here. That could have been your entry right there. Or you also could have entered off of this fair value gap right here. That would have been, you would have had to wait for the retrace, but you could have entered at 5:05 a.m., 5:10 a.m., anywhere in there. And again, when I talk about the smaller stop loss, let's compare that real quick. If you'd entered right there on the chain and state delivery and put it above the high of the day, that would have been a stop loss of, you could have got away with 10 pips. If you would have did the retrace to this fair value gap right here and put your stop loss above the high of the day, you could have got away with like 6 pips. Okay, that's a good small stop loss. And yeah, those are the two main best ones, so either one of those would have been fine. So this one or this one. Obviously, this one's the better one. It's just sometimes when you see a fair value gap, there's no guarantee the price is going to retrace to it. Sometimes it does, sometimes it doesn't. But the price should hold. So I'm going to go ahead and stick with the entry right here and go back to the 8-hour chart. Hopefully it doesn't do anything crazy. And then get rid of these indicators real quick and see what we would have got for a profit between candles 2 and 3. And at the most, because it did retrace. Let me get rid of this and this just so I can see the line clearly. I deleted the wrong line. I wanted to get rid of the change state of delivery line. I just want the entry. Okay, there we go. All right, so at its peak, you would have been good for, if you got the perfect bottom, 34 pips. If you would have waited to the candle close, that would have only been 19. So you get what you can when candle 3 does show up. So, but USD CHF, it's a lower ADR pair, so that's why it only went for 30 pips. It doesn't move a lot. It's not a very volatile pair, but that's what you're going to want to study. Okay, so this was the candle 2. If you had just did candle 3, once again, that would have been good. If you got in right at the open, a perfect bottom, it would have been good for like 27 pips or so. If you'd have held, you only would have got 12 when the candle closed. So, you get what you can. So the difference, sometimes it's not going to be that big. I'm going to be honest with you. It's really not. It just depends. You don't know. But candle 2, like I said, this isn't the big move. The big move was always still going to be candle 3 for the most part. So let's wrap this up. But that's what you're going to want to study. In conclusion, you're going to get stopped out thinking you have a candle 2 when you're really trading against the overall trend. So don't be shocked when you lose a lot trying to get candle 2. Okay, it just is what it is. When you get stopped out, not if, but when, you have options, you have a plan. Of course, number one, you obviously want to manage risk, set a stop loss. But you can wait for the next change state of delivery. You can wait for another fair value gap. Or another option is you can give the pip about 20 to 25 pips away from where you first got in and then wait for the process to repeat because you're trading reversals. All right. So what do I mean when I say that is that, let's say, if you thought this was the high of the day, let's just say the $1,700, the 1,700 candle, and then you see how it made another high, it'll basically be the same thing, right? Because this was the first high and then this was the second one. So let's say if this was 1 a.m. and then this turns into 9 a.m., sometimes the high won't happen at 1, it'll happen at 9, and then it'll reverse. So you just try to wait for that, but you give it some time because from this high here to this next high that was only 10 pips. Okay, because like I said, that's not a very volatile pair. On other pairs, though, it may be like 50 pips. You never know. But eventually, the only guarantee you're going to get in trading is going to be you're guaranteed to have a high and low of every single pair and every single day. But from then, it's just a matter of what happens after that. But you're going to have a high and low of the day on all of them. Okay, so that's that. But just have a plan when you get stopped out. All right, know what you're going to do. Don't try to check every single. No, there has to be something that don't guess what the high is. You have to wait for some type of formation to say, okay, if nothing else, a change in state of delivery is pretty easy to see, or a fair value gap. Okay, but you have to have something. Don't guess and try to think you've nailed a high when there hasn't been any type of retrace. In other words, if you're selling, let me wrap this up here. I don't want to make this too long. Resist the temptation to put an entry right here and say, okay, I think this is the high. Says who? Okay, even though, yeah, it's good to see in hindsight, but guess what? Somebody thought this might have been a high, and then look what happened. Okay, somebody might have thought this was a high, and you got some price action, but eventually it just came right back up. So don't try to, every entry that you make probably is going to be on a red candle when you're short or on a green candle when you're long. All right, it should already be moving in that direction. But let this play out. Don't guess and say, okay, well, I think, this is the high right here. No, don't do that. Just say, okay, you know what? This is the high. I think this is going to be the high right here. And of course, you had that fair value gap, obviously, right here. And price shouldn't go back up here. You know, you need to know where you're getting out before you get in. Okay. And if you're wrong, you're just wrong small. There's nothing wrong with being wrong as long as your account can absorb the losses. Okay. But just remember, risk management is still number one. Small losses are what's going to keep you in the game, not big wins. Okay. You're going to get very few big wins between a whole bunch of small losses. I'm telling you that now. Every day is not going to be a big win. It's just not. I wish it was, but it's just not. Okay. So because of that, manage risk. Just keep your losses small and you'll be fine. So I appreciate your time and attention. Thank you so much for watching. Again, that's Candle 2. So, if you want to make that your focus, that's fine. If you want to disregard all of this and just stick to Candle 3, that's fine too. It's up to you. But, do what works for best for you and your business. But thanks for watching and have a great rest of your day. Take care.